Hello class. Today we're going to be going over the cash flow statement. This is a representation of a formal cash flow statement, just so we can take a look at it. We're going to be going over three financial statements: a multi-step income statement, a comparative balance sheet, and the statement of cash flows, just to take a look and get a lecture of the run over of what we're doing. You may recall that at Accounting 101, we had two different methods of accounting. One was the cash method, which recognized revenues when cash was received and expenses when cash was paid out. And then we moved on to the accrual method, which is part of generally accepted accounting principles, the way we've learned right along to do things, recognizing revenue when it's earned rather than when cash is received, and recognizing expenses when they're incurred. Not recognizing not matter of whether cash is received. So there's always been a difference between the cash flows and the net income from a company. And there's even a difference between the cash from operating activities on the multi-step income statement and the cash provided by operating activities. So we'll see a difference between that as well because of non-cash transactions. But the income statement, the cash flow statement, starts with net income, and we break down net income into cash increases and decreases for the year. There's some things we'll be adding and subtracting. We'll go over this formally into the second video that we'll be doing. But we break down net income into cash from operating activities, cash flows from investing activities, and cash flows from financing activities. And finally, the difference between these should be the difference of the increase or decrease in cash for the year. So let's go back to the income statement. Let's start here. And notice it's a multi-step income statement. And notice that the net income is $40,000 for the year. That's what we'll be using there. The operating income here is $38,000. Just keep that in mind, $38,000, because the net cash provided by operating is $70,000, and the difference between the two I'll explain at the end. But a couple of things we'll need off the income statement is net income, obviously. We'll need that to start off doing our cash flow statement. And some other things in here like the depreciation expense, which we'll be adding back in. It's another cash flow, non-cash flow operation. We depreciate plant assets for the expense, and there isn't really a cash transaction at the time, so we'll be adding that back in. So there's another thing we'll be needing from here. And you'll notice that things like gains we'll be using in the cash flow statement. We'll be subtracting gains out. Notice it's not part of operating activities here, but we're going to take it out of operating activities on the cash flow statement and put it where it belongs in the investment statement, the investment part. So there's a couple of things that we'll be needing from the income statement. The next statement we're going to go to is the comparative balance sheet. And the comparative balance sheet, the end balance is from one year, the current year, and the end balance is from the year before, which in courses, the difference between these two are really the beginning balance of the year and the end balance of the year, because the end balance of 2024 is actually the beginning balance of 2025. So this is really the beginning balance and end balance for the year. And what we do is we subtract the beginning balance from the end balance. So we have the end balance minus the beginning balance equals the change, or the increase or decrease in the balance sheet. So we'll be using some of this as we go along for the cash flow statement. Okay, so, and you'll explain more of this, how it works, in the second video as well. But there are some things that you should notice here. Also, one thing that we would use from here, we'll be using the current, we will have the cash beginning balance, end balance, and the increase or decrease, which will be given. So we have a check figure. But we're going to be using the current assets and changing current assets and changing current liabilities in the operating section. So we'll need these numbers here. to follow through. At the bottom, what also we'll need from here is the difference in retained earnings. I want you to notice the difference in retained earnings is $30,000. And retained earnings consist of net income minus dividends, right? That's what the balance would be. We noticed that before net income was $40,000, but the change in retained earnings is only $30,000. Okay, so the difference between those two would be the dividend that was paid out. So that's one thing to keep in mind. Sometimes they'll give you the number, what the dividend was declared and paid, or you may notice it from here. You can figure it out from here. The difference between the change in retained earnings, which dividend comes out of, and net income, which feeds retained earnings, will be the amount of the dividend that's paid out. So you'll need that information. And you'll come back to the cash flows from operating activities, again, which is broken up into 3 sections as opposed to the 2 sections that we've seen in the income statement. So we start with net income, and we're going to add and subtract some things, and we'll end up with the change in operating cash flows. So the first thing that we add back is depreciation expense. Okay, we add it back because it was a non-cash activity. When we expense the depreciation on the plant assets, we credited accumulated depreciation, not cash. But it also, the expense lowered net income. So this is one of the reasons we're adding it back into operating activities. Gain on disposal of asset. We subtract out the gain on disposal of asset because we're going to be moving that down here where we had cash receipt from the disposal of plant assets, which would be the book value plus the gain. So we're going to subtract out that gain, and we're going to be adding it in here. Okay, the book value was probably $40,000, and the gain was the $10,000. So we're just moving it from operations to investing where it belongs. We have an increase in accounts receivable. Okay, we subtract that out. I'll be showing you a chart which makes this a little easier to complete. But if accounts receivable increased, that means cash didn't go out to pay. You know, that we didn't receive cash, we increased our accounts receivable. The net income, the difference between the two would be that increase in accounts receivable that we didn't receive cash for, so we have to subtract it out. Decrease in merchandise inventory. We're going to add that back. Remember, it's a decrease in cost of merchandise inventory. And the difference between the comparative balance sheet and the cost of merchandise inventory is because we paid for it. We paid cash for it, so that's coming back in. The increase in accounts payable, same thing, we're going to add that back in because we haven't paid it. We didn't use cash to pay it, so the accounts payable increased. So that's going to be added back in. And a decrease in accrued liabilities, the same thing. We paid off some, we used cash to decrease the accrued liabilities, so we have to subtract it out. I don't expect you to remember this. I have a chart, like I said, in the next video, which gives you an easier way of adding and subtracting these things from operating activities. When we get the subtotal, we bring it over, we add it together, so we had a more of a positive cash flow. So actually the cash provided from operating activities was $70,000. Okay, we remember before it was $38,000 on the income statement. Move over for $38,000 for operating income. Okay, but actually that was operating income, but actually there was a $70,000 increase. Okay, and the difference between the $70,000 and the $38,000 is this $32,000 here. It's the $10,000 gain, which was not a non-cash increase in net income, so we've moved it down to here. The increase in accounts receivable, another $17,000, and a decrease in accrued liabilities. If you add these up, it comes up to the difference, the $32,000 difference, to make the actual cash inflow from operations at $70,000. From here on, it's very easy to do the rest. Okay? The difference is between the comparative balance sheet, you just follow the cash flow. There was a cash payment, you subtract it out. This is the investing part. So it was a cash payment for the acquisition of assets. So cash flowed out, so it's a negative. You'd reduce it. Cash receipt from disposal of plant assets. That was a cash inflow. You add it, subtotal, you bring it over. Cash used for investing activities. You actually spent $260,000 in cash on investing. And then there's financing. Receipt from issuance of a notes payable, we received cash. Cash payment of notes payable, we paid out cash. Cash receipt from issuing of common stock, we received cash. Cash payment for purchases of treasury stock, cash was an outflow. Cash payment of dividends, remember I told you before, the difference between the retained earnings was the $10,000. This is it right here. Cash payment was subtracted out. Gives us a net cash provided from operating activities. And then when we do the math here, this is a subtotal, 70 minus 260 plus 170 comes out to a net decrease in cash of $2,000. And if we go back to the beginning, we can see here that there's a net decrease in cash account of $20,000. So we're just taking some information that we have that's given to us, doing some additions and subtractions for operating activities, moving some things and doing some additions and subtractions for investing activities, and also cash flows from financing. We'll be adding and subtracting some things, which gives us the final cash flows that we need. Where did that $20,000 negative cash flow go? When actually in operations we actually had a cash inflow of $70,000 from investing activities because we bought equipment, we bought plant assets, was a negative $260, and a positive $170 from financing activities. Just breaks it down to the three different categories, so that we can better compare ourselves, against previous years, against our competitors, or the industry average. So I'll be going into the next video, which will make more sense of this, to how to compute a cash flow statement. And we'll have some basic tools that will help us do it quite easy. So thank you for your time. I'll see you in the next video.